Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcello. I'm a client portfolio manager at IGAM, and my guest today is Marc Gagnon, portfolio manager, North American Equities. Marc is an award-winning portfolio manager with a long track record in Canadian equity, real estate income, and small cap strategies. Good morning, Marc.
Hi, Rose.
Thank you for being here. Today, Marc will update us on the reasons why the Canadian stock market has lagged global equities, the expected impact of the pivot in monetary policy in Canada, as well as risks and opportunities of the upcoming US elections on our stock market. My first question for Marc is really the performance of Canadian equities so far this year. It has been decent performance, but it's not quite on par with what we've seen in other regions, particularly the US or even the Japanese stock market, which emerged as the pleasant surprise of 2024. Marc, what are the factors that are driving this disparity?
Well, I think I'm going to talk a little more about the U.S. because we often compare to the U.S. and in terms of knowledge, risk return. It's probably the biggest opportunity if we look to invest elsewhere than Canada. One thing that is driving the U.S. performance, and I've been driving actually the U.S. performance for the last 18 months, is all the development with artificial intelligence. It's really, there's a lot of enthusiasm, both, in technology development and also market performance, stock market performance, because of that innovation. And that's quite normal. That's a real sizable change in terms of innovation. But it's important to realize that now most of the stocks that are involved with that innovations are quite important for the S&P TSX, the S&P 500 index in terms of weighting. We're talking about more than 1/3 of the index is exposed to the company that are gaining a lot from artificial intelligence. So, I don't know for sure if or even when or even more when we can hit a hair pocket regarding, those stocks because, of course, growth in earnings is fairly high and expectations are high too. So maybe at one point, even though the development of the innovation continue to be pretty interesting and pretty fast, maybe the stock market at one point will get ahead of itself, and we're going to see some disappointments and therefore some setbacks in terms of negative performance. If it happens, I think that the U.S. market will show a different kind of performance because, as I said, those stocks are really important. One reason I think also that we are in a good position right now with the Canadian stock market is where are we in the economic cycle and what is the response from central banks, both in Canada and the Fed. And I don't want to go too much ahead in terms of, giving details about that idea because it's part of your second question. So why don't I let you ask it and then I will go on and explain a little more what I think or what I see because of that.
Indeed, Marc, you're getting ahead of yourself. So the next topic I wanted to cover was indeed monetary policy. So the Bank of Canada acted ahead of the Federal Reserve and they made their first policy rate cuts of this cycle. What are the implications that you foresee this having on Canadian equities in the near and medium term? And I guess I'll follow up with another question, which is you mentioned the sectors that have done well or worse in so far this year, two sectors that are very sensitive to interest rates, consumer discretionary and real estate. They have not kept pace with the TSX. With that change in monetary policy, do you anticipate them they will receive a boost? And what are the general implications of the market?
Okay. So just to exactly go on with what I was on my way to say is, and you really, name the what was the conclusions of what's going on right now in terms of economic cycle, both in Canada and U.S. The Canada is a little ahead of the United States in terms of slowdown. And I'm not going to talk about recession, although in Canada we're pretty close to a recession. Um, and if you look on the per capita basis, we're actually in a real one. But in the US, we're just starting to meaningfully slow down for different reasons. And that's why the Bank of Canada is a little ahead and went ahead with their first rate cuts. In the US, there's still talks about it, and we see that the Fed wants to do it at one point, but they are also entangled with the election, so it might delay the reaction. So I think that Canada is a couple of months ahead in terms of saying yes, the impact of a recession on profits, so it's a bit negative right now. But once you can add one or two more cuts, rate cuts to what we've seen, then people will say, oh, we're going to get out of the recession and profits will get better and all the market will react to that. We will see a multiple expansion in Canada. While in the US, we're more about to see those earnings having some, difficulty, some softness. So that's one of the reasons I think that Canada is well positioned right now, especially if you combine with a potential air pocket for AI stocks that it's not. I do believe that it will happen. How severe it will be and when it will be, that's another question. But if you combine the two, that's where I think Canadian market will really show, a strong face and be outperforming the U.S. market. And by the way, it's interesting to talk about, the fact that some sectors in Canada, for example, the material sector is up, since the end of February, 24%, and that's better than any of the U.S. subsectors. So some sectors in Canada are already performing quite well, especially since we believe that we have a synchronized recovery around the world and mainly in Europe, to be more precise. So those sectors are performing well, but as you said, Rose, some are having more difficulties. You have the consumer discretionary, the communication, the real estate. They're all having a tough time. And for sure, a rate cut will help those sectors. And for example, personally, I like the consumer discretionary. I'm mostly a growth investor, but I can tell you that at this time in the economic cycle, you have to be a bit of a value investor because it's possible to find very interesting consumer discretionary stock right now that have a very interesting valuation of 10 times PE and even lower than that, which is, on an historical basis, quite low. So consumer discretionary is quite interesting. That's a sector that we are overweighting right now. We will continue to overweight and probably add some more, although most of our position have been built. I think our positioning there is done at 80, 90%. So it's some adjustments, some adding, but it's mostly there. And also another sector that is a little more work for us to be done is the real estate sector that has suffered a lot since the beginning of the year. I think it will react very well to the upcoming rate cuts, which is might not be the case of communication sector. I think it's going to do better, but there's some structural issues with those companies. More precisely, there's kind of a little price war going on with certain companies like Rogers, Bell, and TELUS trying to adjust to the acquisition of Shaw by Rogers. So it's going to be interesting to follow what will happen. Price war is a little more subdued right now, but it's still unclear how things will settle. But that's a sector that at one point will be interesting, I'm pretty sure.
Wow, you're being pretty active. And I want to go back to two sectors that you mentioned briefly, but that have been the two sectors that have performed the Canadian stock market so far in 2024, materials and energy. Do you anticipate the trend to continue, and how have your mandates taken advantage of it? Are there any adjustments you're making in that space?
Yes, yeah, I still believe, this is a part of the strategy that's been working so far this year for us. I still believe it will, with, straight stock market doesn't go up, always in a straight line, and we're seeing it right now with, for example, copper stocks, because the commodity has taken a pause. At one point in May, it was possible to pay, a pound of copper more than $5 per pound. Now we're back to 450 levels, so a 10% correction. The stocks have taken a pause. Some have even, had a negative return since then, which is quite normal. And to be honest, it's not really a preoccupation for me. I think that the bull market is still fundamentally sound or structurally sound. But yeah, there will be pause. There will be some correction. That's normal. But we're still believer in base metal. We still like gold with a lot of uncertainties, on different market that we are witnessing. Geopolitical, mostly uncertainties. So we like gold. And we continue to like energy. And on the energy side, we see a structural opportunity for natural gas to show itself as a very valuable commodities for the next 15 months. We will see a lot of increase in export capacity in North America during that period. And I think we're one normal winter away, because weather has an important role to play with natural gas, but we are one normal winter away to see a very interesting returns for that commodity, both in terms of producers, a company that produce natural gas, and also service company, the ones that drill and frack those wells. They should respond pretty well to that environment. So overall, yeah, continue to be positive. I want to stay overweight there, or sometimes, it's not always in the weighting that you have a bigger economic exposure than the index or your competition. It's, you buy more smaller cap company, and you play, along the market cap line, and you try to find company that has more torque to a better commodity. And that's a way that I like to play. I manage a small cap fund, so I know a lot of small cap in Canada. And I think that's one way that I have a good, added value approach in terms of adjusting not only the weighting of the sector, but the risk and the torque exposure of, my companies to a specific situation.
Great detail answer. It gives a lot of view on how active you are being.
Yeah, I'm
I'd
a bit active, I must say.
So, Mark, I'd like to finish with the inevitable question, the US elections. What do you see as the largest risks and also opportunities within each likely outcomes at this point? That is a Trump victory or Biden victory.
Yeah, that's gonna be an important thing that will unfold in the upcoming months. We're gonna hear more and more about it because the election is only in November. I think the first thing we have to figure out though is Biden gonna run, or will he just step aside? That's still a possibility. We're a couple of days after his catastrophic debate last week. So there's still talks and rumbling about the fact that he should step aside. Will he? That's an important question. It's his decision. There's no mechanism to force him. It depends whether he decide. But there's strong voices inside the Democratic Party, Nancy Pelosi, for example, that are really kind of indicating that it might be time for him to step aside. So will he be the guy that will, try to beat Trump? That's the guy or the girl, by the way. Uh, that's an interesting question. And if it's not the case, then I wouldn't say all bets are off, but it's going to be a big change for sure in terms of probabilities who's going to win, or the impact on the race at least. So that's one thing. The other thing is will Trump, if he's elected, will he have a united Congress and a Republican Congress? You have to to have both the House of Representative and the Senate that are Republican to have a unified Congress. Senate, it shouldn't be too hard because most of the seats that are in election this time are Democratic seats. The Senate, there's always 1/3 of the Senate that is going through an election. So this time it's about 20 seats, and I think there's 12 that are Democrats, something like that. And the other chamber is the House of Representatives. This one is a little more of a toss-up. So let's say that he gets both a House of Representative Republican and a Senate Republican, then he has more possibilities to implement his program. And his economic program can be summarized at this point about three main actions. And these actions are both going to be negative for interest rates. And furthermore, or if we go at the root of the problem, for inflation. So the first one is might reconduct his tax cut that he elected in 2016. So that means, a bigger deficit, and maybe that could translate with higher interest rates for the long term of the curve, the long part of the curve. The second possibility, he's talking about putting a lot of tariffs, 60% on China, 10% on all the other countries that do business with the U.S., export to the United States. Uh, one of the thing he says is, don't worry, it's not going to mean higher prices for the U.S. consumer because it's the country that export, or the company that exports, the companies that will pay for that tax. It might be in part true, but it's not going to be, the case for all the companies and all the products. Some of the products, at least, and I would suspect most of the products, their net margins is even not 10%. So they're not going to absorb all the tax if they're going to, lose money on every sales they're going to do. So, it's going to be interesting to see what will be, the outcome of that promises. But if it's put in reality, that could be quite a damage to inflation. And the last one also, and this one will be even more, to me, damaging because it will be a long-term problem. And he wants to cut immigration, and he even wants to deport, to send back immigration from where it's coming from. It's going to be very hard on the legal front. But even though it doesn't happen, and he cut immigration to a bare trickle, that means that there will be a lack of labor for all those service industries, like hotel, hospitality, restaurant, and so on. These immigrants are really important to make, to clean the rooms, the different rooms in an hotel, to cook, in restaurants and so on. So that will be quite damaging in terms of inflation, labor inflation, which is the root of an inflation problem in every economy. So a long answer to tell you that depending on the different scenario, it could be negative. It's way too soon to really sound too bearish and to act on that, but that certainly need to be followed at this point.
Thank you, Marc. Very interesting. And I'm really looking forward to further conversations we'll have throughout the year as we get closer to the US elections. I know you have a deep interest into everything geopolitical, but especially political.
Me either. Me either, I can tell you.
So I'm looking forward to that. Well, thank you so much for our time today.
Yeah, it was a pleasure.
Thanks, Mark. Have a great day.
Thanks.